Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Across the top here, we've got three tabs: stocks, options, and Forex. So, for example, if you want to learn more about spreads, you can click on options. And we have tons of stuff on selling, shorting puts. So, Charles, you're asking about naked puts, spreads, straddles. Yep, we've got all that kind of stuff. So, over here on the left-hand side, there are three primary courses. You'd find a lot of information for that in the second course, picking the right options and using options in a portfolio. But we also have a lot of material just on the strategies themselves. So how to within each of these categories, we've got lots of examples of, well, okay, so how would you trade a straddle, and what kinds of things might you look for in a straddle? And you can find it all here just on the main tabs. If you're interested in an option strategy like straddles, you'd click on the options tab, and there'd be information that. But by the way, if you're interested specifically in learning more about Forex options, like available from the ICE, if you click on the Forex tab, we have an entire course just on that. So over here on the left-hand side, you'll notice there's underneath Forex investing guides, Forex options. I think there's about 18 different lessons. Each one of them has about a 10-minute video attached to it, and you can access that all there. Once again, we don't charge for anything. You don't have to register for it.
Hey, John, I have a question from Susan. Do you mind going back through, you don't have to go to the chart if you don't want to, but the relationship between, let's say, the AUX and gold? I think she just sort of missed that, and she's very interested.
Yeah, sure. So, gold and the Aussie, they have a relationship with each other because the Australian dollar is one of those currencies that we call commodity currencies. There's three of them that are in the majors. There's the New Zealand dollar, the Aussie dollar, and the Canadian dollar. The Aussie, in particular, has an unusual correlation with gold. Number one, they're a big gold producer, but just in general, as gold moves with commodities, it tends to move with the Australian dollar. So what that means is that rising gold prices means that it costs you more dollars to buy an ounce of gold. Well, if you're importing that gold from gold producers, which would be in Australia, you're going to have to convert those more dollars, by selling them out into the market and then buying Australian dollars that you can then exchange for that gold. So when gold prices are going up, it's kind of this double impact because gold prices are going up usually because the dollar is going down. That hasn't been true recently, but usually because the dollar is inflating and losing value against other currencies. But also it drives demand for the Aussie, in which you have to have Aussies to import gold in the first place. So new gold production comes from these commodity currencies or these commodity economies like Australia, and so it drives demand for those currencies. And what that means is that you can see here on the chart here, since the middle of last year, and the long-term chart on the Aussie was outrageous as commodities kept just going like crazy over the last few years. Remember how oil and gold and all these, they were on this real price run? Well, the Aussie was mirroring that until about the middle of last year, and then it just collapsed with commodities. And what happened was that as gold and as oil began to collapse in the middle of last year, or the latter end of last year, the Aussie began to collapse, and you can see that in this chart here with this big rise in value where the dollar was just gaining against the Aussie. That's what caused that trend. Well, what happened was that all of a sudden traders started to use gold as a store of value against uncertainty. So they would move into gold investing. So you can see that I just brought up the gold mini futures here again, and you can see the gold was collapsing in the middle of last year. That's just what I was talking about. It's collapsing in price, and then about November it turned around and began just going like crazy. Well, we can go back to the Australian dollar, and you can see there in November, all of a sudden the Aussie stops losing value. It starts to stabilize. Well, part of what drove that was demand for gold is very supportive for the Australian dollar, so it stopped this losing streak. Now what happens is, if gold prices collapse again like they did the middle of last year, then the Aussie is going to lose that support. And right now it's up against resistance here, so it's going to lose. If it loses that, that fundamental support, the dollar Aussie currency pair here, which is what the AUX options are trading, is going to go up again, just like it did during the last collapse from July through October. So that may have been too much detail, but I hope I answered the question.
No, that's actually perfect. The one question I have, so I guess what I'm thinking is something's not right. That's what you're saying? Gold shouldn't be making new highs, and the Australian dollar, not that it made a new low, but it almost made a new low. Something's not right, and that's what you're saying, essentially.
Yeah, I guess I would summarize it by saying that, look, you know what? Anytime you have a trend that's based on fear, it's inherently volatile. And that's what's been driving both demand for the dollar and demand for gold, but particularly gold. So if that trend actually did turn out to be unstable, which right now it looks like it may, I mean, we had a big reversal today, $32. That could really hurt the Aussie, and we could see some new lows on the Aussie, which means that the AUX here could hit some new highs.
Actually break out.
It loses value against the dollar, yeah.
Right. And you're right up at that trend line, so that it's closer to be breaking out than breaking down the U.S. dollar, right? Wow, that's
exactly right. As technicians, we would always look at this. We would look at this opportunity as, if it breaks above this consolidation level here, if we get a nice definitive break, maybe into the 160 range, or from a technical perspective, that's a good break, and we'd start to look for some opportunities to go long. That may mean, one of the great ways to take advantage of that would be just by buying a call on the AUX, maybe looking for something in the long term, and maybe limiting that risk with some short positions against it.
Very interesting. Recently, though, the dollar has sort of been repatriated, and I mean, it sort of scares me if the dollar is to rally even further. What does that mean for the equity markets? You think it actually could mean it could be positive, even though the last year the dollar's been rallying and it was a negative for the equity markets?
Yeah, but I think that it wasn't there wasn't a causal factor between those two. It wasn't the fact that the dollar was strengthening was causing equities to go down, right? It was it was kind of the underlying economic problems were causing both things.
Right.
So I think that one of the things this is really ethnocentric of me to say, but I think it's a reasonable thing to expect that the U.S. will probably start to recover before a lot of the other global economies. Not all, but many of them. And they just because of the position that the U.S. economy plays in the world economy, if we did start to recover, we could see demand for the dollar continue to be high as equities start to recover. That could happen. Those trends could go at the same direction, and they have gone the same direction before. So,
very interesting. Do you use technical analysis on these, John? I think you do, but I mean, Charles is asking when I guess you do it on the spot. He's asking about options. I mean, I never did all my years trading options. I didn't use technical analysis on a derivative. How do you feel about that?
Yeah, I use technical analysis on options all the time. So for example, if we were to go back to the SFC, that's symbol for the franc options, right? I pay a lot of attention to gaps, and in the Forex is so liquid. It trades 24 hours a day, 5 days a week. But when you look at the indexes, you start to get a view as to what's going on at kind of the off hours because the market's closed during those hours. So I pay a lot of attention. So for example, this gap right here at about 113, if I'm selling options, so if I were selling a put, for example, I'd be selling it underneath that level. That's how I would use technical analysis. Or like that Aussie breakout that I'm looking for. If we break out up above that consolidation pattern, then I'm looking for some long positions, long calls. Which is really, I think, very typical of how you would use technical analysis if you were trading just the spot Forex or stocks or futures.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.